Hello everyone. This video today is going to cover the first part of the main project you're going to be doing in this class. I believe I'm calling it 2025 BADM 485 Strategic Management Project, and we're only going to do part one in this video, okay? Part two will come along a little bit later. Um, yeah, we'll touch on that later. So, we're going to go through it together and I'm going to help you out. So to do this, I'm going to go ahead and download this. Actually, all right, let's do that. Go ahead and share my screen. No, share it with everybody. There's nobody else on this thing. There we go. Okay, so if you go into D2L down here, you guys, I just pulled off this BADM final paper and I hid this video overview for the final project. That project is not, you're not doing that, so you shouldn't even see it. The project that you want is the 2025 BADM 485 Strategic Management Project, Part 1. Okay, and hopefully you're not seeing this. That's all you should see. So please download that, save it to your desktop. Now, the reason I'm going through this with you and I'm going to go through it by the numbers is because this is going to be somewhat complex. The reason it's going to be complex and there's going to be a lot there is because I want you to get used to um, understanding the metrics that go into a financial analysis. Uh, I I don't know if I know any other faculty members that have been uh, doing putting all of this together in the manner in which I'm putting it all together. So maybe there are, I just haven't seen them. Okay, so we're going to go ahead and click on that one, download it, save it to your desktop. And I'm going to do the same. I would encourage as you save it to your desktop or wherever you're going to save this stuff, please put your name in front of that title. Okay, so it's BADM 45 Strategic Management. So I'm going to put Bruce Johnson. All right, hit save. No, let's go to the desktop. There we go, save. Okay, so got it up there for you. There we go. Okay, so I'm going to walk through this whole thing for you because there's a fair amount here. Now, what we're probably what I would like to have you do is to do multiple uh, companies to do this project and to do this part one multiple times. Right now, all I want you to worry about is getting it done for one company. Okay. So in my projects, when you get ready to do a submission to back to me in Dropbox, as it says here, please delete anything and everything that is green. Okay. So before I submit this, you're going to read through this because these are going to be your instructions for this project. But before you submit this, delete all of that. I don't want that stuff. In fact, if I see it, I'm going to give you a 5 point deduction because I do not want any of the stuff that's in green submitted. Okay. Those are just my instructions to you. So once we get here, that's when you'll start this. You'll put your name here where it's green font. Please change it to black font. And then give me an approximate date here. Again, please have that as black font when you change that. And then all of this here, you're going to delete that out of there. Please don't submit it. Now, don't delete it right away because these, again, are the instructions that you're going to go through to do this project. Okay. So, in order to do this project, I'm doing it. One of the reasons this whole class is getting redone is actually because of artificial intelligence. Last summer, after teaching this, something dawned on me that we can start using artificial intelligence to pull out metrics that 2, 3, 4 years ago, it would take too long for you guys to calculate. And the chance that you would get that number even remotely close to right was next to impossible. Last summer, I realized that we finally were with AI, we're able to get some approximate numbers that were close enough to being right to do this assignment. So that's why we're changing this, and it is going to require you to utilize artificial intelligence. But I will tell you, if you submit any copy and paste from artificial intelligence, number one. Or I know there's artificial intelligence now that can take anything you write or copy and paste from AI. It can then buffer it so it makes it look like it isn't AI, and then you could submit it to me. If you do that, I promise you, you will fail this assignment. I promise you, because I will be able to tell in a moment's notice. Also, I'm hoping before the end of the semester to schedule or have you complete a video for me talking to me about this project. And if I get the hint that you don't understand what you're talking about, you will not pass this project. Okay. So you're in a capstone project for BADM 485. Again, if you haven't watched all the videos, and that's why I wanted to get all the videos up before we actually start this project, I have a, I, I just don't buy that you're going to understand how to do this project, and you won't understand the point behind it all, because everything we're going to cover is going to be what was in the previous videos. Okay. So we're going to use artificial intelligence, but if you copy and paste crap and you can't explain it, you're going to do yourself a disservice. You need to be able to explain what's going on with that, and you want to explain it in your own words, okay? Not in what artificial intelligence is telling you. Because if that tells you what to do or say and you don't understand it, you're going to have a problem. Okay. So, but we are going to use artificial intelligence. So I'm going to go through this whole thing to sort of to give you the idea of where this came from. And that way, I hope through kind of this narrative, you will understand what we are doing in the project, and you'll be able to write what I'm asking for in this. So um, we're going to conduct a two-part analysis. The first part is you're giving me the current situation of a publicly traded company. You're going to select a publicly traded company. When you do that, I would select a big enough company that you've heard of before. The reason I don't want you to select a company you've never heard of, you don't know what they produce, you don't know what they do, is it's going to make it challenging for you to complete the rest of this. So you're going to select a publicly traded company that you're somewhat familiar with. Okay. So we're going to do a two-part analysis. Right now, we're doing just part one. So the purpose of this is for you to share with me your understanding of the topic of strategic management. Now, there's a reason why there's so many prereqs to this class, is because here we're going to put it all together. And once we put it all together, hopefully you begin to understand how this thing called business actually works. I use the example with students. If they were to write an analysis up of a company, let's say we're going to use General Electric, so you guys don't get to do General Electric for this exercise. But let's say you're using Pepsi, okay? Once you go through this project, what I hope is you would be able to read a Wall Street Journal article talking about PepsiCo, and it would it would just make perfect sense why the board of directors, why the CEO is doing what they're doing with this company, because you will have learned the tools and how the tools are applied to create a strategy, and it will just make more sense to you. Uh, I would say 10 years ago, when I taught similar topics as this, I did find students that were like, oh, wow, now this makes sense. We're going to put it all together. Okay. We could not do this without artificial intelligence. It doesn't work because students end up focusing way too much time on trying to find the data points. Then they have to take time to try to run the calculations. And by the time you get through all that, they don't even understand what they're looking at. It doesn't work. So with artificial intelligence, I'm hoping we get this so you guys can much more quickly put everything together. And again, it's probably not what you think it is. Okay. It wasn't for me once I understood how to do this, more or less. So I want to use a little bit of an analogy here, a narrative to understand what we're doing. So I want you to imagine for a moment that set the idea of business aside, and I want you to imagine that you're a medical doctor working in a hospital. Okay. We're going to call you a family practice physician. Okay. So you're a doctor. Um, a year or two ago, my daughter went to the doctor and she was having very serious stomach pain and she had been absent many days from school. We thought maybe it was like a virus. And then we realized this is not a virus. We're not sure what's going on. So we end up taking her to the doctor, tried a couple things, nothing worked. Um, then we went on the journey of trying to figure out what was wrong. So this family practice doctor ended up sending her to three or four different specialists. When the specialist reviewed everything, they had her take just a battery of different tests. She had to go through numerous procedures, surgery at one point, and then experimental treatments and medication, trying to actually solve the problem or the ailment that she had. Most of you have all been to a doctor, and at a minimum, most of you, I'm sure, have had a blood test done. And you've seen what's called, or you understand what's called a CBC, where they take your blood and they run many, many, many tests on it. But it's not the doctor that's running the test. The doctor is only one key component in the whole complex web of healthcare uh, procedures and tools and all sorts of stuff. So the question I would ask you is, do you think a medical doctor, how much do you think they would understand the complete ins and outs of every test that they run? And the answer is they probably don't know that. And I actually looked this up. So when my daughter's doctor had gone through all of these tests, she reviewed them, she had specialists review them, and then she tried to explain to us, okay, each one of these numbers indicate this, and she was reading these off, and she said, this one's a little concerning, this one not so much. Now, when I read through one of those, I saw this thing called a CBC, I forget the exact title of it, but it was a test. Um, and I dug in to figure out, well, what is the science behind this one test that they're looking at? And I believe it was on the number of white cells, white cell count, and other blood cell count. And as I was reading through this one test, I read where what happens is they have a microscopic analysis shining a high-powered light. Um, and the light is streamed on what's called an asomatic, as asotomic, it's this word right here, impulse through the test. Now, I would bet you all the money in the world if I asked my daughter's doctor, hey, how did the variations in electrical impedance and the light scattering impact the osmotic impulse in the blood test? My daughter's doctor would look at me cross-eyed and say, I don't know what you're talking about. I haven't the foggiest idea what you just asked. See, what my daughter's doctor is looking for is a number. She's looking from the results of the test that was ran. She doesn't know about the science and the whole background at how that number is derived. Now, that doesn't mean my daughter's doctor is an idiot or something. It's just the world is so complex. Many times we we don't necessarily know the calculation at how to figure out the interest coverage ratio. What instead you need to know when you're running a business is, what is that used for? What does it mean? And what should it be? What shouldn't it be? And how do we get it to what it should be? So you need to understand the result. Trying to understand the formula behind it, well, maybe that's fine, but you're frankly, you're just not going to have time. You need to understand, like my daughter's doctor, what the number should be. How do you alter it? How do you change it if it's incorrect? What is it indicative of what's wrong? And then again, what are some medications or solutions you can use to try to fix that? So that's what this exercise is trying to accomplish. Okay. Again, in business and in accounting and economics and finance and all of this, it is too complex to sit here and try to have you guys run a bunch of numbers that you don't understand. But there are some numbers you do need to understand and some inputs you need to understand because they have a pretty profound effect on the company and its value. Now, fundamentally, I want you to remember that the goal of the agent is the CEO, the board of directors, though it's named in the articles of incorporation and in the bylaws. These are the officer billets that are hired guns to run the company. That's what an agent is in business. Okay. Now, when an agent is hired to do that, they need to know what are they allowed to do, what are they not allowed to do. And they very much like a doctor though, they don't need to know everything, but they do need to know what levers do you push and pull to get a desired result. And for the most part, the intent behind the agent doing that, and this you need to memorize this till the day you die, is the agent's job is to increase the value to the shareholder. Okay. And we need to know, well, what does that mean? And in essence, what it means is you're trying to get the stock price to go up, the total value. So when we run what's called a valuation, you need to know what in essence, what the numbers and inputs are in that calculation so you can understand its impact on the company. So that'll be one of the first things we do. Okay. Now, I hope my intent is on the other side of this project, you will have a much greater understanding of why and how and what is it that these agents do to run this company. What are they looking at? Why, as a doctor, what are they trying to figure out? Well, if we have this problem, what solution, what medication, metaphorically, do you have to give to solve this? And that's what we want to get there. But again, it's not, you have to understand the whole formula. It's equivalent to understanding for a doctor how the body operates, how it breathes and why does it breathe and what does breath do? What happens when you take away breath? And so you're understanding how the whole system operates. Now, I think I have a fundamental idea of how the body operates. But if you get into detail with a lot of that stuff, I'm going to get totally lost. And at the end of the day, I probably am not going to completely understand it. So our goal again is to get you to a point like a doctor and a patient is an agent, is a person running the company. You understand the formula. So you're pulling the right lever and doing the thing that we need to do to fix or grow the company. Okay. Now, when we go through this, I pulled this type of decision-making analysis from Whelan and Hunger, 1994, and this is their decision-making process. So you've seen a lot of the stuff that we're going to talk about in here. Okay. You've done a SWOT analysis before, and if you haven't, I don't know how you got in this class because that's a basic one that's done in marketing, it's done in management, it's done in almost every field. So we're going to go through a similar process, similar, not the same. I'm adapting this from Whelan and Hunger, and it's been updated multiple times. Okay. So that's kind of the idea, the framework of how we're getting to where we're trying to go. And the first piece of that is trying to understand the current position of the company. Where are we at today? Now, before we go on again, I want to remind you that I am asking you to use artificial intelligence. But if you copy and paste directly from it and you don't understand the number that I'm asking you to get or understanding what that means, you're going to have a serious problem because we're going to have a conversation. If I can tell you don't understand, well, then I'm going to go ahead and assume everything that you've just submitted here is you copied and pasted it from ChatGPT. Okay. So don't do that. Here, like the blood test and the doctor, you're going to use AI, ChatGPT is the one most people use, to pull a number, to pull a piece of information. But it's your job to make sure you understand what is that piece of information, why is it important, and what do we need to do if we need to fix that number or change something. So we're going to first find the current situation. The part of the changing you maybe don't even need to worry about today. Okay. So again, there's two parts to this project. The first part's the current situation. There'll be a different video and a different document where we get to the strategic decision making and what we should do. I also hope as we do this, you'll begin to start seeing the tools that we've gone through, when they're used and how they're used. Okay. All right. So on page, where are we at? Page 3 here, strategic management part 1. Please leave that there. I'm going to go ahead and do this as if I was you guys. So we're going to walk through it exactly like that and give you today's date. Again, I'm going to make sure that's black so you don't forget to not delete it because Bruce needs that information. Okay, we'll leave that there. Okay, so the first part, you need to select a publicly traded stock or company. Again, pick one that you've heard of before that you understand. Maybe you have the products of that company or you really like it or something. And it does have to be publicly traded. We'll show you how to figure that out. So the first thing we do is select it. I'm going to do General Electric. So step one is, okay, what company am I selecting? General Electric. It's actually General Electric Aerospace, ticker symbol GE. Okay, that's all you have to do for that first part. A little space there. Next, we're going to do what's called a valuation. We did a couple of these earlier and very quickly. If you've taken a management or personal finance class with me, actually almost any class, we go through these so you understand the impact and its importance. Now, in personal finance, I teach it from the standpoint of finding a good undervalued investment. Now we're going to do it, and we're looking at it with a whole different lens. It's the same, it's a different side of the same coin. As the agent, as the CEO, we're looking at this different than if we were looking for like a good investment. Okay, but we're doing the exact same thing. So, okay, conduct evaluation of a publicly traded company of your choosing. Now, you're going to need these websites. So I want you to click on these, open up Yahoo Finance, this Money Chimp /articles/valuation/Capium, have a Chat GPT tab open. If Yahoo Finance does not work, you can use Seeking Alpha is a backup, and that usually works pretty good if Yahoo Finance doesn't. I'm going to just show you Yahoo Finance because it usually has the numbers and it's easier to read. Okay, so part B, conduct evaluation of a publicly traded company of our choosing. Now, right here, we have preliminary metrics that we are going to use when we run this calculation. Okay, so the first one comes from what I call iBotson data. I actually got it from Skloff.com, which is a financial services firm who is does pretty much the same thing iBotson and Associates does. They might change the numbers a little bit. Okay. So the information I need is what are the historical rates of returns over a many year period, usually like 60, 70, 80 years for these different size companies. So if you have a company that's market capitalization, if you added up all their shares of stock and multiplied that number by the dollar value of stock, that's where you get the size, the market capitalization. So we are going to go ahead and go into Yahoo Finance, and I am going to hit GE General Electric. So you need that open. I was looking at speakers earlier. Why? I don't know. Okay. So we have General GE Aerospace ticker symbol GE, which actually is an interesting kind of thing because they have divested and tried to get out of many of the other business lines that they were in. Okay, so this is the page we need for General Electric. I'm going to shrink that one tiny bit, so hopefully you guys can see everything there. There we go. GE. So if we were to add up all of the outstanding shares of stock times this $249, you would get a market capitalization of $265 billion. Okay. So I'm going to go back to my Word document. Is General Electric above 10 million? Is it between 1 to 10 billion or is it less than 1 billion? The answer is it's above 1 billion. They are a large company or a large capitalized company, large cap company. So their historical rate of return is 10.1%. Now, if you found a company that's smaller in size and they're between 1 and $10 billion for the market cap, that's called a mid cap stock or mid cap company. The historical rate of return is a little more, 11.4%. And that's based on it's a long story, but just use these data points. If you were to do a company like Daktronics, if you added up all their shares of stock, their market capitalization, which would be in the same spot as what I showed you in the Yahoo Finance, it's right here. Market cap would be probably less than $1 billion. So Daktronics would be a small cap. I'm doing General Electric, so it's a large cap. So I need to kind of remember this 10.1%. The next piece of information we use to do a valuation is something called a risk-free rate. The risk-free rate of return is typically the rate of return on a 10-year treasury note. Um, which is a bond, a 10-year treasury bond. And the world over looks at that 10-year US Treasury debt as a risk-free rate of return or the closest thing to a risk-free rate of return. Still, as of 2025, that is the number used. In another 10 or 20 years, maybe it'll be Italy's, you know, bond or something like that because they've always made good on their promise to pay their bondholders. So that's basically what we're saying is what is the lowest risk rate of return I can receive um, that is kind of a guaranteed sure thing. So we're going to use this long-term 10-year treasury note. The ticker symbol to do this is caret symbol TNX. You don't need to worry about that. Disregard this 13-week, although I do keep it up there because you see the bizarre predicament we are in 2025. Normally, those are not so close. Normally, a 10-year or a 91-day treasury bill would be something like 2%, and then the 10-year would be 4.23%. What that means there is right now, bond investors do not know where the world is going to be in 10 years. So they're paying a lot more money, or the government's willing to pay a lot more money in the short term. Um, and then in the long term, it might actually be less than that, which is really, really, really bizarre. If this number, this 13-week number, gets above the 10-year, that's called an inverted bond yield curve. And if that happens, we know we used to always go into a recession. Okay. So those are very close. So those are kind of alarming. Now, sorry about all the chat there. All you need to remember is this 4.23%. I am not going to ask you to pull these numbers here. You're going to use the date. I put this in the document because you're going to use these data points. So you need to know the historical rate, benchmark rate of return, and then you're going to use for the risk-free rate 4.23%. I've also added this number in here that I want you to be aware of, but you are not going to use this in the valuation. As I put right here, this is not used in the valuation. But I want you to know what the current Wall Street Journal prime rate is. We look at that number as the base rate that banks use to borrow overnight to each other. The lower it is, the more it incentivizes people to go borrow money. The higher it is, the more people don't want to go they don't want to borrow money because it's too expensive. So they like to keep their money in the bank where they can earn a high savings account. That prime rate that prime rate is the basis pretty much behind the whole economy. And whether or not we are trying to get out of a recession or we're expanding too quick and we need to slow things down, the Federal Reserve uses that rate as a lever or a tool to either speed up the economy or slow it down. Okay. So what I want you to remember is right now the current prime rate's 7.5%. Last month it was 7.5%. Last year it was 8.5%, so it was higher. At that time we thought the economy is heating up too much, so the Fed raises that rate. The average over the last 20 years has been 6.85%. So right now, it's a little more expensive than it has been for the last 20 years. Okay. The last piece of information we have here is when we do our valuation is something called a leveling off rate. Okay. Now I'll put those inputs in and actually do the valuation. You're going to do it for a different company, but it's the same formula. So this leveling off rate is we're trying to forecast and predict what the growth of the company will be. After about 5 years, we always assume it goes back to normal growth or average growth, which is CPI or inflation. So if it's a mature company that's probably not going to grow very much anymore, they're just maybe having a good 2 or 3 years, we level it off to around 3%. Okay. Usually it's between 2 and 3% to make life easy for us. We're just going to put it at 3% or the rate of inflation. So all things go back to normal. Now, if this was a company in a very early stage of their business, let's say it was Facebook when they first went public, they were expected to grow by about 9,000% more than the size they were when they first went public. If that's the case, then we will level off the stock or the earnings when we forecast them. We will level that off to a much higher number than 3% because it's a high growing company. So if it's really expected to grow a lot more, you might level it off to 5%. If it's a company that's in this part of their life cycle, they're still growing, but they're getting kind of closer to maturity, then we might level them off to 4%. You're going to select this one of these numbers. Now, when you select it, you have to be able to defend it. If you say General Electric is in, its growth cycle, it's still got a ways off to grow. I'm going to argue you over and over and over again. No, it's not. This company's a mature company. They've been around for, you know, 80 years or however many years. They've been around for a long, long time. Obviously, that's a mature company. Now, a couple things to note I'll don't panic. I'm going to show you the inputs of how to do this. Okay. When you do this, you do not want to select a company that has not yet turned a profit and they've just started trading on the stock exchange. You stay away from those. If they haven't turned a profit and they don't have any earnings, ignore it. Okay. Investors also don't want to invest in companies that are declining. So investors don't invest in companies when they're over here and they're expected to go down, unless there's something goofy happening and maybe they're going to get acquired or something like that. So usually we level off to in this red area. Okay. If it's expected to grow by leaps and bounds more, maybe you level it off to 5%. If it's expected to grow, it's getting close to maturity, but still could grow a fair bit, 4%. Otherwise, everything else we put as 3%. And that says that there. Okay. So here's going to be your valuation, and how we're going to do this. So I'm going to walk through this. So starting at whatever time minute this is on the video, you might want to write that down. So if you need to go back to see how to do it again, go back to this time marker. Okay. All right. So the first thing we need, we're going to use General Electric. We're going to do a ticker symbol, and that is GE. So I'm going to type in GE. Over here, this tells you where we got that information. So I used Yahoo Finance. Next piece of information I want is the P/E ratio. So where do I find that? Yahoo Finance. I'm going to go back to Yahoo Finance, and their price to earnings ratio for the trailing 12 months is 39.34, which is high. The average is like 16 to 17. So I'm going to put that number in there. That is not a dollar. That is a ratio. So it's not a percentage. It's not a dollar. Again, 39.34. Next piece of information I need is a benchmark or comparable return. Where do I get that? From above. This, from the iBots and data, is where you get that number. So General Electric is a very, very large company. They're a large cap company. Their historical rates of return for large cap companies in the New York Stock Exchange is about 10.1%. So I'm going to go down and I'm going to enter in 10.1%. Next, what is the risk-free rate for the long term? I'm going to scroll back up. We're looking at this long-term 10-year Treasury note, and we're going to enter in 4.23%. Now, if you're in a later semester other than summer of 2025, uh, I will update those numbers. Okay. So every year they change. So I'm going to put down here risk-free rate 4.23. Well, how about percent? Okay. Next, this is that big number we were talking about before. This is it. That's the thing. If you've ever heard risk and return, that's where we start entering that equation into what we're trying to do. The higher risk something is, the higher required rate of return we must have. So our beta coefficient is how we interpret risk. You're going to find that on Yahoo Finance. So I'm going to go back to Yahoo Finance, and right here we have the beta coefficient, monthly 5-year running, and we have 1.39%. A beta coefficient of less than 1 means it's lower risk than the market. Beta coefficient of 1, perfectly 1, is the same risk as the market. And a beta coefficient above 1 is more risk than the market. So I'm going to go back to my document. Again, it was 4 or 1.39. So I'm going to put in 1.39. It is not a dollar. It is not a percentage. It's a coefficient. So leave it as that. The next thing, now we need to start running a calculation. So we're going to go to this website called Money Chimp Calculator. So if you go back up here, okay, you would click on this Money Chimp valuation. I already have it pulled up. When you get there, it will look like this. So what we're trying to figure out is what is the required rate of return, or the rate of return we should be receiving given a level of risk. Okay. So we scroll down here. First piece of information is that benchmark number. Where did I get that? Scroll back down here, right here. So the benchmark or comparable rate of return is 10.1%. So I'm going to go in the calculator and I'm going to put 10.1%. Next, I need that risk-free investment. Okay. Where did I get that? From that 10-year Treasury note. Okay. Right here, risk-free rate, 4.23. And the last piece of information I need is the risk, the beta coefficient. And the beta coefficient right here is 1.39. Okay. Once we're there, we're going to hit calculate. So based on General Electric's level of risk and based on these two other metrics, we should be receiving a rate of return of 12.39%. That's what we must receive to make this worthwhile. Okay, so I'm going to write down that 12.39 back into my document. It says discount rate, radar risk adjusted discount rate derived from the capital asset pricing model. I'm sorry, I forget 12.39. All right, now we need to go to the next calculation. So we need the earnings per share for the trailing 12 months, EPS TTM. So I'm going to go back. Whoops. I'm going to go back into Yahoo Finance. And I need to find the EPS. And right here, we have the EPS, earnings per share, trailing 12 months. And we get 6.33. And because I forget, 6.33. Okay, we're good. The next piece of information I need is the earnings growth rate. Okay. This number and this metric can come from like 25 different places. I showed you in a previous video, Seeking Alpha has, I believe it's 23 different ways of doing the same thing we're doing here, but you have to use the same input in it. So just to show you, if I go into Seeking Alpha, okay, another website, I type in General Electric, I pull it up. Okay. You also have those numbers. Oh, you notice those numbers are different here. That's fine. We're going to follow Yahoo Finance. If I go over to this growth tab though, okay, here all of a sudden we have all the different growth rates and all the 23 different ways to run the same calculation. Okay. When you do that though, the earnings that you're entering is not the same thing as EPS. If you look right here, you have earnings per share growth rate year over year. Down here, you have the earnings per share uh, gap growth rate year over year, EPS growth forward. Okay. And you notice some of these are shrinking. Now, the question all of you should be asking is, Bruce, there's 23 numbers. Which one do you want me to use? That's fair enough. What we're going to use is the 7.57%. That's what I'm going to use. I'm also going to go in here and I'm going to ask ChatGPT, what is the earnings growth rate for GE? That's not what I wanted. Here we go. EPS growth quarterly is 17.3%. But then when we go down here, their historical earnings growth rate, their projected annual growth rate is 9.4%. I think I'm actually going to use this. They're close, not the same, but that's good enough. Okay. We're looking for the earnings growth rate, so 9.4%. So I'm going to go back in here, earnings growth rate for the compounded annual growth rate of 9.4%. All right. Now is when we have to do some estimates. So where do we find this estimate of the leveling off rate? From above. You're going to scroll up. And our question is, what phase of business is General Electric in? Are they in a growth phase of business? Are they in a upper growth towards maturity? Or are they a mature company? General Electric is a mature company. So we're going to level them off to 3%. Now we got to go run some numbers. Okay. So you want to pay attention here carefully. We have almost everything we need to figure out, is this a undervalued or overvalued stock? So we're going to go back to this capital asset pricing model calculator. And here's where students often get confused. We ran the discount rate, or the required rate of return given a certain level of risk. I can understand the frustration in the world of business and finance because we often call this thing like five different things, but we're talking about the same number. So that's another reason why I'm wanting you to do this and do it often, is so you understand that we're talking about a lot of the same thing when we're doing this. Okay. So when you're in the capital asset pricing model calculator, you already calculated the discount rate, arrow over. Now we're going to enter in all the data points that we pulled from up here. Okay. So the first input we have is earnings per share trailing 12 months. Okay. And that is $6.33. So I'm going to go back in here and I'm going to enter $6.33. Those are expected to grow at a rate of what? Earnings growth rate CAGR 9.4%. So I'm going to type in 9.4% for the next 5 years before leveling off to what? 3%, because we said they're in a mature phase of business. Okay, so now we're going to run our number. We're going to hit calculate. This number, this discount rate, was from our previous calculation. Okay, so you don't change that. Leave that alone because it came from the beta coefficient, the risk-free rate, and comparable rate of return. Okay, so all you have left to do is hit calculate, and you get a stock value per share of $89.89. So I'm going to go back in here and I'm going to type in $89.89. Okay. Now we need to figure out what is it currently going for in the stock market. If I want to buy this right now, how much is it going to cost me? Okay, so we're going to go back to Yahoo Finance. Right now, if I want to buy this as of 3:30 on July 1, I can buy it for $249.02. So I'm going to go back here, $249.02. Yep. Okay. So here's what we just figured out. Given the company's earnings, okay, and earnings are like the cash the company gets to keep after all the cost of goods sold, and after all the other expenses that the company has and the costs they have. This is like the cash that you get to keep. So when you invest this $249, you're getting $6.33. So if we divide 249 by 633, that's where you get this 39.34. The price to earnings ratio. You're just dividing the current stock price by the earnings. Now, a lot of people think in business that it's the earnings is what you're trying to get. It has nothing to do with the earnings. It's the earnings are forecasted. We try to figure out what they are. The question is, how much are you willing to pay for it? So we think that the stock price is only worth $89.89. But if we want to buy it today, it's $249.02. Okay. So if we think it's only worth $89, but you can buy it for $249, if you were an investor or potential investor, you would look at General Electric and say, holy buckets, that thing is overvalued. The stock price is way higher than what we think it's worth. Okay, now that's if you're a potential investor. If you are the CEO, if you're the agent that's running the company, this is awesome because your job as the agent is to get that stock price higher and higher given the level of earnings and given the level of risk. You're trying to get it overvalued. The agent, the CEO, the corporate board is the same thing as what a real estate agent would be for the sellers of a house. If you're a real estate agent and you're trying to sell a client's house, you want to get as much money as humanly possible. So if you run the numbers and figure out, well, our market analysis says this house is worth $200,000, but you're a rock star real estate agent, you're going to try to sell that for 250 or $300,000. And if you did that, imagine what the sellers would be saying. They'd be like, yes, just made us an extra 50 or $100,000 by selling it way more than what it's worth. So that's the job of the agent is how do we run this? So investors look at this and say, this is such a great company. They are locked on. They know what they're doing. They know how to do it. That investors would be willing to pay substantially more than what they think it's worth because of all of those things. And when you begin to realize that, you're like, oh, that's why these CEOs and these corporate board of directors are doing what they're doing. Okay. They're doing it because there's a relationship to the value of stock. Guys, has nothing to do with earnings. When earnings go up, then the intrinsic value, the calculation down here, also goes up. It goes up lockstep. So then what does the CEO have to do in the company to make the stock price overvalued? And the answer is decrease the risk. Try to reduce the risk as much as humanly possible. What's the risk? It's the ability to predict what's going to happen next. So when a CEO can get that under control, they usually use it now with Six Sigma, lean manufacturing, and other things. Once you start doing that, then the stock price goes up. Your earnings maybe didn't go up. Why? Because you're making it look more attractive than it might otherwise be. Okay. So here's the next part you need to do. Part C. Give an analysis of the valuation from the standpoint of the agent, the CEO, which is the chief executive or corporate board of directors. Please note, we're not looking at this from the standpoint of a potential investor. So what I just saw was the current I'll change that to black. The current stock price is $249.02, which is many times higher than the intrinsic value. So this means the CEO or the agent has done a great job increasing the stock value higher than it would otherwise be worth. Now, one question might be, is there a way to get it even higher than it is now? Okay. Now, we're going to do that part in the next section in part two. Right now, we're going to leave it at this. Now, I don't know how many words. If 200 words might be too much, if you give me like, I don't know, 2, 3 sentences talking about that, go on ChatGPT and Google what do you have to do to make a stock overvalued, or what does a CEO have to do to make the stock overvalued? See what it says in there, and then maybe put that in here. Okay. Now, one of the ways that a company can do that, I'm adding this in now just so you're aware, is again, similar to a real estate agent trying to increase the value of stock or the value of a house more than what the average would be, or the law of averages would be something called Rappaport's 7 drivers of value. Okay. So Alfred Rappaport found 7 different ways the agent can increase the value, all things relative. And here's how the company can do it. They can increase their sales growth. They can increase their operating profit margin. They can decrease the tax rate. They can increase their capital expenditure or CapEx. Okay. Uh, their working capital can be better managed. What's the working capital? That's the money that gets borrowed in a short status from the bank. Okay. This planning period is actually increase the time period of competitive advantage. Okay. That would be another way to do it. And then lastly, decrease the cost of capital. Okay. And that's where it's going to get into our next part. So if the CEO, now, when you write this in there, yeah, I'm copying and pasting it. I'm also going to delete it. Okay. CapEx is capital expenditure, which gets into another number later on. Um, and then I would put the rest of these. Uh, Better manage your working capital, and the planning period is time period of competitive advantage, and it should be increase the time period of competitive advantage. Okay. And then lastly, it would be decrease the cost of capital. And that's what we're going to talk about next. Okay. So I would type all that into C here. Okay. Analyzing the stock value of the company. Okay. So I'm going to delete that. I'm actually going to delete all of it. Well, I'll give you a second here so you can kind of copy that too. So you're going to want to cite Rappaport's seven drivers of wealth. If you put this, well, you need to put this in. Okay. Rappaport's seven drivers of wealth. So I would, again, make that all black and leave that. Okay. And I'm going to remember to delete out this 200 words. Next, in part D, list the current competitive advantage. Okay. Now, I don't know a heck of a lot, or I'm going to pretend like I don't know a heck of a lot about General Electric. So, my first question is, why do people buy the products or services from General Electric? Okay. Now, here's what I'm really looking for. What's their value discipline? Do people buy it because they have great products? Do they buy it because they're cheap? Or do they buy it because General Electric has great customer service? Or do they do it because there's some locational component to, why people buy it? Okay. Now I know because I've done previous research is customers generally buy GE products because of their quality. If you want a light bulb that lasts longer, don't buy the generic great value, buy the General Electric one. By the way, that's just like a really good point in general, and I didn't know this. I had a couple electricians tell me this. Don't ever buy the great value LED lights. Always buy the General Electric because those actually do last 10,000 hours. The great value ones do not. Okay, so I'd put in there customers generally buy General Electric products for their quality. Okay, now what's the value discipline? GE has harnessed manufacturing processes and Six Sigma and lean manufacturing to increase overall quality and long duration or long lasting. Okay, something like that. Okay. So for part D, why do customers buy this? Might be easier if you, when you're answering these, to make your notes in bold or italicized so you can know what's Bruce's outline and what is not. Okay. Then I'm going to delete all this. Now, one thing before we go too far. When I am asking you what their value discipline is, I am not asking you to give me an example of product leadership, operational excellence, customer intimacy, and locational excellence. In fact, if I see you put that in there, you're gonna fail this part. I'm just gonna take out the deduction in points right away because that's not what a value discipline is. That goes against the whole theory. The idea behind the value discipline is the company picks one of these and they try to compete in only one of the three or one of the four dimensions. Why? Because otherwise you try to be all things to all people, which is the story I was telling you about working with a board of directors or executives and why do people buy this product and everybody says a different thing. No, that's not what a value discipline is. You want to select one of these. Now, how do they do it? Okay, that's the next part. What are their core competencies? And maybe here I can put back in there Six Sigma, lean manufacturing. It might be their core competency is their recruitment. recruiting from MIT or, um, top tier engineering school, something like that. That's how they're achieving what they're achieving. It's the how part of it. So I would write down all of the core competencies. Now, if you don't know what the core competencies are, well, where could you find that? I don't know. Maybe Chat GPT. What are General Electric's? And you're going to go back. You're going to hit General, not eclectics, but electrics. And what do we find? Primarily operating as GE Aerospace after it's broken up. Core competencies, engineering and technology. Okay. Their global supply chain. This one I didn't know. Industrial software data analytics. So what you're going to do is when you're putting down those core competencies, yeah, seven would be more than enough. Is you're going to write these down. You're going to put, okay, what's their core competency? Engineering and technology. What on earth is that supposed to mean? They have a high level of expertise in aerospace engineering, gas turbine engine technology, and mechanical systems. Okay, so I might go in there for a core competency. They primarily operate as an aerospace company and expertise is top notch. Okay. Then I'm going to go, what was the next one? I'm not copying and pasting directly from there. I will know if you're copying and pasting directly from ChatGPT. Okay. You need to smith it in your own words. So you're going to read through those and then you're going to write it down. Again, don't don't copy and paste it directly because you can quickly tell if you've done that. Okay. Now we get into the next part. Okay. The next part is the information through this valuation. That just told us a bunch of different things internal to the company that you or the average person is probably not otherwise aware of. Okay. So we're going to go back down. The company's discount rate. We just calculated their discount rate, which is the risk adjusted discount rate that we derived from the capital asset pricing model. What was that rate? So I go back up. The discount rate derived from Capium is 12.39%. What does that mean? It means based on a law of averages, based on a level of risk, the equity holders of General Electric should receive a rate of return of 12.39%. If they're not able to, then they should go elsewhere. Okay. Now, next question. What is the company's average cost of debt? Where do you find that? Artificial intelligence. So we're going to go here. What is General? Now you guys are saying Bruce just copy. It should give you a percentage. There we go. Okay. So yeah, we're going to use this pre-tax one. So if General Electric needs to get more money because they're going to invent some newfangled jet engine that hasn't been made, if they want to go get money to do that, okay, and they have to go out and get additional equity holders or money from stock investors, those stock investors need to get that 12.39% rate of return. If they can't get that, then they don't want to give the money to General Electric. But General Electric has another source of capital, which is debt. They could go to a bank and borrow the money. So if the on average, when you add up all the different bond issuances in the banks that General Electric has borrowed from, when you get a weighted average of that, you get a cost of debt. So their average cost of debt when their CFO is trying to figure out well, how much is our average cost of debt so we can figure out what to invest in as far as projects go. They know that their cost of debt need is 7.2%. So that's what it has to pay back to the bank. Why does this matter? The next question, what's the company's weighted average cost of capital? So the weighted average cost of capital will take the company's capital structure, their total number of debt, and their total equity. They will multiply it by that equity by the 12.39% and the debt by 7.2%, and that will give you a weighted average cost of capital. Because when the CFO is trying to talk with an engineering supervisor on a newfangled project, the CFO is not saying, well, there's all sorts of numbers we got to crunch and da 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 da, and they go through that. What the CFO does is says, we're going to set a hurdle rate. We'll have our finance people come in and calculate everything for you. Once you do that, you're going to run a pro forma capital expenditure to figure out if you have a rate of return that is higher than this rate. So that rate is usually derived from something in the by the weighted average cost of capital, and then it gets changed. Okay, so I'm going to go back, say, all right, we're going to use this number right here. Their weighted average cost of capital is 9.3%. Excuse me. Now look at, let's say 50% of their financing is done through equity and the other 50% is done through debt financing. You would take what's 50% as a weighted average of 12.39%. So that would be 6.2, give or take, or a little less. 6.2, what's 50% of 7.2 would be 3.536, 3.6. So then you would add that number plus that number, and you would get the weighted average cost of capital. So we're going to use 9.3%, which is between these two numbers. Okay. Now, based on this information above, we're going to try to figure out what would General Electric's logical hurdle rate be. The hurdle rate is usually derived from either the weighted average cost of capital or the weighted average marginal cost of capital or weighted marginal cost. It doesn't matter. We're going to use weighted average cost of capital. The, okay. We're going to estimate it based on this number. So imagine you're the chief financial officer and chief executive officer of General Electric. Okay. So I'm going to put, I estimate General Electric's current hurdle rate. If you were trying to give a rate of return that a project needs to receive, would you set it at the 9.3%? Probably not. You would probably increase it because you'd want to have a little margin of error. Okay. But you wouldn't want to put it so high because remember, your job is to get the cost of capital down. Remember when we did Rappaports, you're trying to decrease the cost of capital, which we can talk about later how you do that. Okay. So I estimate General Electric's current hurdle rate should be probably less than that, but it needs to be more than the weighted average cost of capital. So what would you set it at? What's a rate of return a project has to receive in order that the CFO can make sure this is getting paid back? I would set it at 11%. Wondering where did I get that number? I did kind of pull it out of thin air. I wanted it to be less than the cost of equity because we have debt. I wanted it to be more though than their weighted average cost of capital because I want a little bit of cushion. You know what? I'm going to change my mind. I'm going to set it at 10.5. So when their CEO and their CFO start reviewing projects and ideas to manufacture new products or to go after new customers, the way they figured out how to do that is they run a capital budget, and they usually use what's called IRR. NPV and IRR, it's the same thing as a stock valuation. We figure out what are the earnings expected to be for the next 50 years or how many years we're operating here, and then what would you be willing to pay for it today? Now, I think it's like 60% of companies use this idea of a hurdle rate. So, what they would say is, we will consider going through the project if your internal rate of return on this idea is higher than 10.5%. If it's not higher than 10.5%, then forget it. We're not going to look at it. Okay. Now, if they wanted to be a little more risky, they might want to bring that hurdle rate closer to 9.3. If they wanted to be a little more conservative, maybe they're going to have it higher. You probably wouldn't want it higher than your cost of equity because you become inefficient with your capital structure. But you'd still want it less than there. Maybe you put it at 11 or 11.5, something like that. So you're trying to estimate because mentally we want you to think, well, what we have to pay back this money to both our stockholders and our debt holders. How much does that need to be? So that's your hurdle rate. Okay. Now we're going to dive into a little bit more. And here you're going to have to use artificial intelligence. Okay. You're going to do the same exact thing we did with Chat GPT before. Okay. You're not going to copy and paste it directly. You're going to use your own vernacular to explain this. So in part F, number one, what is General Electric's financial performance for the last 5 years? Okay. So what is GE's financial performance? Here's what I want you to remember. The term performance. Performance is the income statement or the profit and loss statement. It's like a basketball team. How are they performing? Well, I don't know. How many shots did they get? In a business, I don't know. How much revenue did we generate? What were our cost of goods sold? Have we shrank them? So, what is General Electric's financial performance for the last 5 years? I'm not asking you to put in an income statement. I'm trying to get you to figure out what the financial performance is. Okay. And look at that. They're going to give you, whoop, went too high. So here's what you'd want to start communicating. You can look at this. Well, what was our total revenue? Of that total revenue, 75.8 billion. Okay. How much was our net income in 2020? Well, it was 5 billion. Okay. So if you're to think of that as a percentage, okay, then let's look at 2021. Did it go up or down? Well, your net income went down. So, well, that's not a good thing. Earnings went down. Why? And that's where they get to here. What happened? Why did that net income go down? Because a pandemic hit, turning profits into substantial losses. Okay, so what happened? Well, they started losing money because people stopped buying airplane tickets. Therefore, they stopped buying jet airplanes, which is where all the money comes from for General Electric Aerospace. Okay, what happened in 2023? They had a rebound. Okay. Um, and they surged a net income of $9.2 billion. Then in 2024, what happened? Things normalized. Okay. So we had a really crappy year where a pandemic hit. Then we had a huge surge because we were coming off the pandemic and all of a sudden sales jumped again. And then we got back to what a year of normality would be is in 2024. Okay. So you're going to read through this stuff and you're going to just communicate. You don't need to use numbers. You can add in like 39.7 billion if you want, or an increase of 15.65. But what I really want is what's happening? What's the story? Okay. You could read, I don't know how many pages worth of income statements and detailed income statements. You're never going to remember. That's not going to help you at all. What I want you to do is get out what's the story? What is the story that this is telling us? Because that's what you want to pay attention to. Okay. So you'd go through that. Okay. Now, God, honestly, here's what I would do. I would probably copy and paste, whoop, yeah, all of that into a Word document. If this was me, a separate Word document. I would print it off, I would put it on my desk, and I would start reading through it. I'd say, okay, in 2020, 2021, what happened? The pandemic hit, just like all companies in the United, or most companies in the United States. We had huge losses, and they had a substantial loss of 6.6 billion in 2023 to 2024, and then give me the narrative of that. Okay, so you're not copying and pasting directly from this because I'm sure you've already caught now, guys. I can read this pretty quick and figure it out if ChatGPT said this or if you said this. Okay, well, next, we're going to do the same thing for the financial condition. The condition is the balance sheet. Sometimes can deal with the cash flows, but it's in the last 3 to 5 years, what is the financial condition? What we're looking for is the balance sheet. How many assets did it take to produce this income? And then it will go through and talk about that. Okay. Next, in this financial analysis in part F, you're going to do a ratio analysis. This is super easy because all you're going to do, and don't, by the way, don't copy, give me a sleep M analysis in Chat GPT because it's not going to know what you're talking about. So the next one I would look at is what was GE's debt to equity ratio in 2024? We'll just do the last year. You don't obviously want to do 2025 because it's not done yet. Okay. So in 2024, debt to equity, it increased to 1.00. That doesn't make any sense. Um, there it is. So you're taking your total level of debt and you're dividing it by your equity. Okay. So if you have a number that's more than one, okay. So let's say you had 50 billion in debt and 10 billion in equity. Okay. 50 in debt divided by 10 in that, you'd get a 5. Okay. So here, prior to the pandemic, they had a high level of leverage. What they that means is they had a high level of debt relative to their total equity. Now, then they paid off a substantial amount in 2023. They went down to 0.77. Okay, so they had more equity than debt. And now they're moderating at 1.0, which is a 50-50 debt to equity. Okay. Now, then go through quick, say what it means. Now, here's the thing where I'm going to pick you apart. You need to understand why it is a company wants more debt. Why would they want that? And the answer is because it gets their weighted average cost of capital down. Okay. Because debt always has a lower cost of capital than equity. Okay. So when you think about that, then the next logical question would be, well, how much debt can we take on? Like, can we just keep going till it's 100 or 1,000 or 1,000,000? I mean, how much debt can we take on relative to equity? Because the more debt you have, the lower your cost of capital. On top of it, it also causes a leveraging effect. So then if you're an equity holder, you're not just earning 10% a year, you're earning 1,000% a year or 5,000% because you've leveraged it. You have to pay the debt holders their share, that 7 point whatever percent, but then you're able to take on as much as you want and it benefits the equity holders. So why wouldn't you just want to keep taking on more and more and more debt? Well, the answer actually has to do with risk. At a certain point, you take on so much debt that the equity holders start that beta coefficient, they'll start increasing that higher and higher because this is getting more and more risky because we don't know if we're going to be able to pay this back to the debt holders. So you become over leveraged. But what most students don't understand is they think, well, let's pay off debt. It's like, no, it's the other way. It's let's take on as much as we can. Okay, well, how much is too much? And the answer is you actually watch the stock price, and every time you take on more debt in your balance sheet, your debt increases. What happens to the stock price? If the stock price goes up, then take on a little more debt. Okay, then what happens? The stock price go up or down? Well, it goes up. Okay, take on a little more debt. All of a sudden, you take on X amount, and then the stock price goes down by 20%. That's your signal that you just took on too much debt. Other than that, the answer to how much debt should we take on would always be more. Okay. And there are so many calculations into figuring out that amount. But what I'm trying to tell you is a company that's a mature company like General Electric that's been around the block for a while, why wouldn't they want to take on more debt? If we go back to our weighted average cost of capital up here, whoops, okay, the more equity you have from the standpoint of the stockholder, okay, um, or from the standpoint of the agent, the CEO, the higher your cost of capital. The more debt, the lower your cost of capital. So if you imagine the weighted average cost of capital would be something between the two. If you had all equity, then it would be almost 12.39% if you had no debt. If you had mostly debt, then that goes down and it's less than your cost of equity. So it decreases your cost of capital. So why wouldn't you want more debt? And again, the answer is, well, how much debt is too much? It's when the stock price starts going down because equity holders say, nope, this is getting too risky. Other than that, there is no technical formula you use. You compared it, well, what are other industries, comparable industries? So for General Electric Aerospace, you want to look at like Pratt and Whitney. What, how much debt do they have? And if they have 80% debt, or let's say like three ratio, debt to equity ratio of three, so they have like, I don't know, 80% of their 70, 80% of their company is financed through debt and their stock price is higher, all things being equal, then if you're General Electric, then maybe you want to take on more debt. Okay, so then you're going to go through the sleep and M analysis. So you're going to go in, you're going to give me the ratio. What does it mean? What should it be? How do we change it? Then you're going to go to the debt ratio and calculate that. And again, you don't have to calculate anything. You just go to Chat GPT and then give me your analysis. Tell me the number, give me your analysis. How can you change it to improve it? In the last question in all your sleep M analysis, are these ratios improving or going in the wrong direction? If they're going in the wrong direction, then what should we be doing? So the questions you're really asking is, well, not what the debt to equity ratio is the company solvent? How's the liquidity situation to General Electric? So you're going to look at these ratios and tell me how would you improve them? Okay. Are they going in the right direction? Is the company efficient? There we look at their turnover. Okay. Do they have too much? They're sitting on too much inventory. Maybe their working capital's too high. So you're going to go through all of those. Give me a quick number. Is this going in the right direction? Is the company profitable? So you're going to tell me what's their profit margin? What's their operating margin? What is their return on assets, their return on equity? And the biggest one in most publicly traded companies we're concerned about is this idea of return on invested capital. So when General Electric goes and gets more capital, okay, uh, additional to what it's already has and what it's already taken on, does the return, is it higher on that new money coming in? Because that's usually a pretty good indicator. Then, okay, we're going in the right direction. Again, are these improving or going in the wrong direction? And then lastly, the market value ratios. I don't want to just term market value. Guys, you already did this. Okay. You already did this in the valuation. You know what the P&E ratio is because it's right here. P&E ratio of 39.34 is very high. And if you're running a company, that's a good thing. So you'd put that down. And why is it good? Because it's overvalued, and your job as running the company is to make an undervalued asset overvalued. Is there a PEG ratio? The PEG ratio is the P&E ratio divided by the company's expected growth rate. Okay. It's another way to determine, is this overvalued or undervalued? Okay. Does it have a dividend? Does it pay a dividend? If so, what is it? Uh, if it doesn't pay a dividend, is it sitting on a lot of cash and retained earnings? And maybe it should be paying a dividend because maybe they don't have any good ideas uh, to plow this extra cash they have sitting around into a brilliant new idea that's going to generate an even higher rate of return. Okay. Remember, the company sets the rate of return for their retained earnings and their cash as slightly less than their cost of equity. So the CFO in General Electric says, on our retained earnings, we have to figure out how to have a rate of return on that that is slightly less than 12.39%. So let's say rate of return is required from that retained earnings, that cash that's sitting around, of 12%. If the CFO can't return a rate of return of 12%, which is higher than their hurdle rate, then they need to pay that cash out. What they usually do, though, is invest it into some new technology that's maybe going to be a big disruptor and make life good. Okay, now we're going to get into super easy ones. I'm not looking for a ton of information here right now. Get me the nitty gritty. What's the company's history, major milestones? General Electric it was a growing company in the 90s, 80s, and 90s. Jack Welch took over. He grew the company and by 27 times or something and turned it into a multi-billion dollar conglomerate. Its management is like all of the companies in the world want to hire their CEOs and their managers and their executives. What's their mission? What's their vision? What's their core values? Chat GPT, mission, vision, and core values. Copy and paste it directly from General Electric's website or from Chat GPT. That one is verbatim. Next, key business segments, divisions, product lines. What are they? You don't have to put a ton of information there. So at General Electric, let's say 5 years ago, they had a jet engine, they had light bulbs, they had imaging equipment for healthcare. You'd want to just list those. That's all we want at this moment. Next, their marketing strategic position and its intent. Um, Here in General Electric, it would be so huge. What I would say is go back to their value discipline to say they compete on a product leadership capacity. Their intent is to stick with creating new products that are in high demand, that do a better job compared to every other competitor out there. Next, you're going to do a pestle analysis. This again is actually pretty easy. Use Chat GPT and then talk to me from the standpoint of your company. What are the political macro environments that General Electric should be worried about? What are the environmental concerns it should be worried about? What about sociocultural issues that General Electric should be worried about? Technological issues, uh, economic issues, and then legal issues that General Electric should be worried about and concerned. You do not need like 20 things for each of those. If you have one or two, three political ones, one, two, three environmental ones, sociocultural ones, technological ones, that'd be fine. You don't have to write paragraphs for this. Just tell me the important information that one would need to know about your company when it looks out at the world in the macro environment. Next, you're going to do a Porter's five forces analysis. This is or a current situation analysis. This is not something that we're trying to use to forecast right now or plan. We're just trying to look at it today. So that on your master strategy and tools, you have a list of all of the different five forces and what should be included in any of those. Read through those, use AI, Chat GPT, and have it run that and see if you have any matching ones compared to your master strategy and tools and include it in there. Okay. Next, talk to me about industry trends. What industries does your company compete in? What seems to be the latest and greatest? Are there any disruptors or new technology that's expected to come out? What are the growth trends in the industry overall? I'm not asking you for paragraphs worth of information here. I'm asking for the main point. What are the things that the company is going to need to pay attention to? Part M, resource-based view, RBV, describe the resource that the company has over its competitors. Remember, this gets to sustainable competitive advantage. What value, what is the competitive advantage rare or are others able to do it? And then the whole VRIO analysis. So here's what I would do there. What are General Electric's tangible resources? Use artificial intelligence, put it in there. What are their intangible resources? Talk to me about their brand. Is their brand pretty strong? Equity. Again, don't give me paragraphs. Hurry up and just get to the main point. What is General Electric's culture, the company that you're doing? How about its human capital? What's it with its culture and its human capital? How does it treat employees? If it's got a product leadership, their culture then is about like caliber of employee and making sure they're taking care of them. Then talk to me about their value chain analysis. In this one, I could care less if you touch on any of these. Just talk to me about the value chain. How did they create the value and why people buy the product? What is the special thing? Oh, thank goodness. Okay, so you get down to N, the value chain analysis. From there, you're done. For most of these, don't give me huge paragraphs. Get to the point, use artificial intelligence, but do not copy directly. Translate it so I understand it. I will be able to tell very quickly if you used AI and just copied and pasted. And that is it for the situation. Part two is going to be, okay, let's create a strategy based on what we know so far. All right, I will give you the due dates for all of this right now. Please get started. I would ask that you try to get done with this in probably the next, well, I'll put that in an email. You'll probably have a week or two to do it. Don't be dumb. Use AI when possible. Don't cheat off of it. You will need to do the stock valuation and interpret that. And then you need to understand all this because if I sit down and we set up a meeting where we talk, if you don't understand this stuff, I know it immediately, and I know then you have not gotten what you need to get out of this. My throat hurts. I'm going to go ahead and stop there and get a hold of me if you have any questions. We'll see you on the next go around.